Instructions unclear. I'm now convinced that Chipotle is and always has been the play. What's the difference between chop and consolidation? Consolidation is a narrowing of the price range. So as buy and sell pressure reach an equilibrium, there comes an inflection point at which one will outweigh the other, and that will either push the stock up or down. Chop is kind of just like where you're moving up and down in the same range. Like buy pressure here is strong, sell pressure here is strong, and you're really not gaining or losing any value. It's just staying relatively the same. So it's a lack of consolidation within a narrow price range, essentially. Being held in the hands of retail. I mean, no, they're not. Because they're not located, right? There's no locate to back up the FTD. The FTD is simply synthetic. Those FTDs are then cleared through CNS, and then they're gone. If there's no locate in the original transaction, then there is no share used to facilitate it. So what you're talking about, Shroomy Boom, is that the shares that people own are being used as a locate for short positions. And by pulling that locate away, this short position can't be transacted. And an FTD then cannot be created. Right? But this is false because a locate is never used. A short position is simply created. And then it fails. And then that fail is cleared through CNS. Exposure forms through the previous quarter, right? As these deficit positions are taken and options are used through ETFs and indexes to hedge them, that exposure comes due during the OPEX cycle. So the OPEX is sort of the realization of all the exposure from the previous quarter, which is really visible actually on the charts. If we look at GameStop over the course of the year, obviously, like this OPEX cycle had tons of exposure, right? Because of the price action that occurred in January, which was, realized here. And then, there were still very high FTDs and exposure going, and it was very hard, right? With the flash crashing of the stock and massive shorting that occurred from March until May. And then we see, obviously the OPEX cycle here realized very strongly. This cycle provided tons of liquidity. And so the realization of this cycle through August is much more diminished, right? And then from August until November, we really don't see a lot of exposure created, right? Very, very little shorting in this period. This was actually our strongest floor held, like as far as price improvement goes. The bottom of this cycle was much higher than the previous cycles in or down cycles in April and July. And so when we moved into November, OPEX didn't have as much strength, right? The effect was more diminished. They also hedged in advance to diminish the strength even further. But now on this cycle, with massive shorting done over this time period and really no liquidity provided, I expect OPEX exposure to be very high, similar to last February. I'm out of TQQQ. 100% gains are just too spicy to keep holding. Congrats, dude. I'm glad you made a nice profit.